Hey guys, Jay here. This is SmartHelping.com. I'm excited to bring you a brand new template. It was based on the old lending general lending business model, but the update here is essentially an entirely new way to determine loan assumptions, and the entire structure is different. I think it's a little bit more streamlined. It's going to be included in the purchase of the regular, template lending business template. So you'll see that in the link description below. But let's get into what actually is going on here. I'm going to come back to the control tab, but first I want to hit on the loan assumptions tab. So here, and I built this for a client from scratch, and their basic goal was they wanted something that they could use to project out loans, but they also wanted to be able to compare how those loans do against actuals in the future or against a different pool of loans. So the challenge was having a forecasting framework that did that and didn't aggregate everything in um, too much of a like. So the other lending business model, you could put in the number of loans settled per month, and you could adjust that over time for different types of loans, and you could put in 100 loans or 50 or whatever. Um, but the problem with that is you can't adjust it by client. So this is saying, okay, you can have up to 100 unique clients, and these are for larger loans. And let's say you have a client that wants to draw, say, $2 million, or they want to borrow $2 million in up to 3 draws. And start month is, you can define the start month that happens within the model. And so what the model does here now is say, okay, they're going to draw 666,000 in month 1, 2, and 3. Now you can do up to a max of 5. So what I did is there's a loan assumptions tab for the for the 100 clients here, and then based on what you put in here, there's a loan detail, which this has. If I expand it, you can see it has all 500 potential tranches that could be lent out over the 10-year period. And each tranche, so client 1, client 1, tranche 2, etc., max of 5 per client, has its own schedule for repayment, interest, principal, default, etc. So it's tracked in these tabs, and I just did it, O is originations, A is the age of the loan, P is principal repayment, B is balance, I is interest, C is cost, D is defaults. And you can see based on the loan terms, that data populates per client per tranche. So client 1, all 5 tranches there, client 2, etc. And it goes down to 500. Now this actually was less bulky, about 33% less bulky of a file than the original, because of the efficiencies here, even though you're putting in assumptions for individual tranches. Um, so it would not be hard to expand this if you wanted to. You could just drag the formulas down. And if say you wanted to do less time, this goes up to 120 months. But you could make it maybe go to 60 months if you wanted to expand, like do more loans but over a less period of time. Or you could do it over 10 years. And I mean, with 10 years of data there with formulas, I think the Excel file would still run fine with, probably a couple 100 clients, each with their own loan detail here. Now you'd have to copy and paste these down and then reference each start row with the loan assumption tab, and then all this other stuff is automated. You just copy and paste. But anyway, the default, you can do up to 100 clients, 5 tranches each, so 500 total loans individually being tracked here. So if we look at one, just this first one, I have 3, I'll adjust it to 4. So we put 4 in here just so you can see how it's dynamic. So you see on the loan detail, we have client 1, 4 loans being lent out, and one in month 1, 2, 3, and 4. So $500,000 each. So that money the company has to lend out, so you got to come up with that cash, and then they're getting an interest rate. Default rate is going to reduce their cash coming back in. There's a cost per month per client for servicing. You've got a term here, which is going to define how long the loan lasts for, and the amortization schedule. And the end month, which is just a dynamic calculation to figure out when this fixed cost per month per client stops. Okay, so if you look here on the first one, you've got 500,000 being lent out in month one. So there it is. Origination, age, 1, 2, 3, counting forward. Here's the principal repayments. You can see three of them happening here for 500,000 because we put the loan term of 3. Now, if they were, they could be as short as 1 month or as large as 60 months. Let's say it was, let's say a 12-month loan. If I go back here, you can see now there's each of these tranches is 12 months to pay back the principal, and interest is being calculated every month dynamically. You see over here, interest is calculated for these 12 months. Cost, this is the cost of service, which only applies one time for the entire client tranche. So whatever you enter here applies. It doesn't apply per each of the 5 tranches. It's just for the client total. And defaults here. So that's the basic structure we have for originating loans. It gives you a higher touch, allows you to maybe plan out originations more for high value loans, maybe low volume. And so you have somewhere to track and see, okay, here's what's happening, here's what I expect to happen. And if you want to compare what's happening here with maybe the portfolio that this is the reason I built this is the client wanted to say, okay, I'm going to lend the customer $2 million, but I'm lending to them with collateral that they have other loans that are somewhat, it could be a one-to-one match or some amount of match to this amount they're being lent against. And in order to do that, you have to track each individual tranche to be able to compare how it's performing, how it should have performed versus what's actually happening. So this is why this was built. If you're in the direct lending business, you will find this useful. So you could track collateral of a portfolio of loans that are used for collateral against the actual loan you lent out to them, to the client. So that's pretty much it. Now you see we've got income statement, balance sheet, cash flow statement all work together with this. We also still have the option where you can take out a credit facility. So let's say, here in this case, here's another update. So the model, if I put 0 in here, it actually tells you how much equity you need based on the minimum cash position, and now you can manually input it here. So I could put in, okay, well, we need 22,000,009. Maybe I want to raise 23,500,000 for a little bit of buffer. 559,000 buffer. Also, you have the option to some of this money you raise, maybe 90% of it goes to lending activity, and the other 10% we want to invest in something else with some rate of return that you can enter here, and that's all going to affect cash flow. Now here, if we only use 90, we actually have to raise a little bit more. There we go. You always want this to be positive, the min cash position. So this is another difference. Instead of solving for the minimum equity and making that the investment, we're actually showing the minimum cash required or minimum cash position after you define a manual entry for the equity invested. So this is the amount of money you're raising. And you could put in the contribution rate, so how much is coming from investors versus owner-operator. And then you could also put here how much of the cash flow that's produced is distributed to investors versus owner-operator. And you'll see the discounted cash flow analysis for the whole project here. Here's all the cash flows based on everything I just input. Now keep in mind, let's see, we're using this credit facility. Oh wait, this is what I want to show you next. So if you hit yes on the credit facility, look at the change in min cash. So now you have a whole bunch of extra money. So you don't need to raise as much, maybe 20 million. Because now we're saying we want to actually borrow 20% of the cash we need to make all these loans we just input here into the model, which is going to flow. You can see down in cash flow, here's all the activity of the lending, and we're actually going to borrow. This is the percentage we're borrowing to pay for the loan disbursements. And so that's going to create an interest expense, and then you can define how much of the interest you're actually producing from lending out and how much you want to use to pay for things like this interest expense or other operating expenses. And that's what you define here. So I'm saying 25% is recycled into the loan, into new loans. The other 75% of interest is going to be used, available to pay down or used for interest expense. Now, if you put 100% here, you can see your min cash position went down a little bit, and that's because now you're actually not using any of your interest revenue for anything except for reinvesting into new loans. Now, this is only relevant if you're turning the credit facility on. If this is off, then it's none of these inputs matter. But if you hit yes, now you can do this, these dynamic things here, which is interesting to figure out. How do you balance how much you want to raise versus how much you want to borrow with the facility, the interest expense therein. And you see net profit here, 7.4 million. If we don't use a facility, well, now we need to raise more money, back to 25 million, but we're going to get more back. Now it's 9.2 million in profit created. However, we had to put in more money up front. So here, and let's put this back to 100. You can see the rate of return is not great for the investors or the operators here, based on the assumptions I have, which are arbitrary. But if I turn, so right now you can see 3.9, 2.7 for the investor, 8.0 for the owner. If we start borrowing and paying at and I have a really low interest rate in here, 3%, so that's probably not likely. You probably put a higher one in there, maybe 7. But still, you can see with that higher interest rate, you're not getting as much of a margin, so that went down. Let me put it back to 3 and see what it looks like. Still not a whole lot different. Let's see, maybe we borrow more, and then we put maybe 25% here. Now we have a whole bunch of extra money we don't need to borrow. Now we only need about 11 million, and we go over to the discount. Well, we're borrowing too much. Maybe 20%, 25. Okay. That's still rough. So, and this is again a function of your interest rate you're receiving from the clients, how much you're borrowing. Let's say we borrow. And the reason why I separated this out from the loan detail instead of just letting you input every single row is because this allows you to drag down without messing up the formulas, because this dynamically references, so it's like a buffer, so you basically do 5 times less inputs, which I think is helpful. Let's see. So here we're still, you can see interest paid is going up as we originate, and then I think I have the last loan being originated around month 50. So after that, then you see interest revenue start to go down as their loans are being paid off. Servicing fees also go down, but now you've still got defaults here and the interest expense for the loan facility, which is pretty big, even at, well, it's at 7%. If I put it to 3, not quite as large. Now you've got more profit happening. Now the returns are a little bit better with that lower interest rate. But we have to invest more. Actually, still not bad. 6, I mean, it's positive. But again, this will be all input based on your scenario. The amount of money you're raising, what loans you're settling, and how much and when, how many draws there are going to be, when the draw actually happens for the clients, and interest rate and all these terms. Executive summary here you still got, which shows other income, which annual F193. What is? Oh, that's for the if you input this here, the APR, like an extra investment on the initial. If you don't want to invest all in the loans and put it into something else. So that's what that is. We got it 0 right now. But your interest in origination fees, cost of goods sold, which is your servicing, G&A. Now note the G&A is just I needed somewhere to easily put the defaults, the effect of the defaults. So on this cash flow analysis here, we're assuming all of the loans are repaid 100% and all of the interest, but we're calculating defaults as an expense that reduces the amount of cash available. I know it's not exact accounting, but it gets you to the right cash flow number, which is just to say we are reducing. You can see here it's going from defaults from here. We're just saying we're reducing some amount of the interest and principal that's received by that percentage. So if we put a default in here of 2%, it just says of all of the principal and interest that this loan is supposed to be repaid, this percent is not collected ever. And so that just is an offset to cash. It's an expense. And again, I know it's not proper accounting, but it gets us to the right cash flow, which we just want to know roughly based on those assumptions, how much are we investing in these loans and how much are they yielding over time. So that's that. You could also have other G&A costs. So I have a whole cost schedule here for sales and marketing, G&A, R&D, and this you just put the fixed monthly cost, which you can adjust each year and adjust the start month as well. You can account for percentage of total revenue expenses as a percentage of total revenue to maybe catch other things that aren't relevant. Now this here actually is no longer relevant. We can clear all this. This is from the old model where we had 3 different loan types. Now obviously we have essentially 100 different loan types here. You can do an OPEX loan. So this would be like if you wanted to put some money up front for to cover maybe some of the initial interest from the credit facility, or to cover some of your operating costs if you have other operating expenses, just to help at the initial startup, and that'll have interest, principal, and a term which you can define on the OPEX loan tab here. And that flows on the monthly detail. Let me minimize this so it's easier so you can see originations, revenues, servicing costs. Here's your OPEX, sales and marketing, G&A, R&D, EBITDA, debt service from that loan I just talked about, right there. And then all the lending activity detail where we get into the advanced recycling of revenue and credit facility and all that. We've also got some visuals on the executive summary. If we go down, cumulative cash flow, pre-investment funding. So this is just the activity of the project itself. You can see the minimum amount there is this. If we put 0 here, it'd be this number, 21 million negative. Here's the loans receivable, so what's owed to us over time based on our lending activities. And again, the income statement is all connected with the balance sheet, which you're going to see cash, receivables, other investments, which we have zeroed out right now, credit facility, long-term debt, equity, retained earnings, and it all balances. And you can adjust all the assumptions, and that will always balance. You also don't have to run it for a full 5 years. You could select how long you want to run the model for. Let's see, what else do we want to talk about? That pretty much goes. Oh, on exit, you can determine if there's still loans outstanding. So let's say some of these loans were drawn in month 40 in their 60-month term. So that means at the exit month, there's still going to be a balance. If you go over to the balance sheet, you can see here. Actually, looks like they're all paid back. So I did month 4. Oh yeah, because 40 and 60 is 100. We're doing 10 years. Let's say these are drawn in month 72. Now we should have a balance at the end. Yep, a little balance, so 199, and it's actually going to be slightly less, but this will is 1.87. Here you can just enter a multiple, and it's going to give you whatever the value, the par value of those receivables is, less any fees, and that's going to hit your exit cash flow rate there. You also have to pay back your facility if you're using it. So here's principal repayments. That's mainly just, if you can see, if we go to the last month on the monthly detail, that is repayment of this credit facility. Because remember, we borrowed 25% of the lending distributions, and so we got to pay that back at eventually. Or you could hit no if you're just running the model without any repayments at the end and without any exit value. That's fine too. So yeah, overall, it's a pretty nice model where you can adjust some high-level assumptions about lending, as well as some corporate financing structures here, and just see what kind of returns you can produce based on the different assumptions. And like I said, this model was built for somebody who was lending money to clients, and they wanted to be able to track what they expected to get back from clients relative to what the client had in collateral, which happened to be another loan portfolio. And so that's why we have it broken out into each individual tranche, so you can compare this to the loan portfolio, and you'll do things like that to make sure they have enough relative to the total amount they've borrowed or owe at a certain time. What is the loans that are collateral? What's the value of those compared to what you've lent them? So have at it. If you want to try and play with this template, you can go to smarthelping.com and download it. It's you go to the home page. It'll be under the Direct Lending Businesses tab, and I'll put it right in here. Well, actually, it's going to be on the General Lending Business. So if you go to General Lending Business, this is the base template. So it has a lot of what you just saw, but it's just all the way the loans are settled and determined is different, and the dynamic calculations in the background are different. But you'll get both. This one that you see in the video on this, and I'll put another video. Well, this video you're listening to now will be on here, and so for a one-time fee of $75, you will get both this original one and the one I'm just went over just now. You can also buy the bundle, lending bundle here. If I click on that, and it's got a whole bunch of other lending models, lending businesses, some different amortization schedules that could be useful. And I've got more. I've got another thing coming out soon, maybe in the next 7 days. That has to do with the lending business industry. So I'm excited. It'll be a brand new template, separate template. All right. Well, that's all I got for you. If you want to check out more, just go to smarthelping.com. Financial models tab at the top. You can check out all of these different financial models I've done for a lot of different industries. You can buy in bundles. I have them bundled here, or you could just go to the Super Smart bundle and just buy everything on the whole site at once. You could download it, $4.99 one-time fee, and you get all the templates I've built. There's well over 200. Also, you can hire me for $275 an hour to do custom spreadsheet work. Just email me and we'll get started that way. Alright, like and subscribe. See you guys on the next one. Hopefully I did a good job trying to explain all the things you can do with this lending business template.